is your strategy suitable? Okay, I think that's the best place to start. Before I can give you some ideas about how you build a suitable strategy, we first need to ask that question is, do you actually have a suitable strategy to begin with? Now, before I show you a step-for-step method that you can utilize to build your own suitable strategy, I want to share with you how we developed strategies when we started back in 2011. Now, we would sit in front of the computer all day trading. That's how it was. They sat you down, one terminal screen, you split your screen between a chart and a price ladder, and you sat there and you clicked all day. Now, when something worked out, in other words, when you had a trade that worked out quite well, you seemingly understood what was going on, at the end of the trading session, we would go and debrief it. Now, how did we do debrief? It was very simple. We went Control P, and we simply printed the image. We would then take that A4 piece of paper and we would begin the process of annotating that image. Now, in this annotation, we would include the trade idea. We would storyboard it. We would write out the story as to why we got into this trade, what made us believe this was a tradable opportunity. We would identify where we entered the trade. We would look at what was the entry signal, what was that sort of, confirmation that got us into the trade. We would look at an initial target, so we'd point out with an X, this is where we thought it would go. We would also put an X where we believed the stop should be. And then we would note general observations, things we could observe just by looking at that single piece of paper. Now, I'm sure you can all agree that this sounds like a very dated approach to developing a trade strategy. Okay? Now, what we would finally do is we would take that trade that we observed and we would go and file it for future reference. Okay, you ask any trader that was, around in 2011, we would have effectively an A4 book that we would take some, sticky stuff and we would stick it in an A4 book. That is how we built an inventory of trade ideas. Now, what would happen is over time, as you recognize this play of yours or this idea of yours, you would capture more and more and more of these patterns. And effectively, you're just iterating through the same trade idea. And this ultimately led us traders to the process of developing the key trade skill called pattern recall. Why? Well, because the more you observe the same trade idea, and you're observing where did I enter, where did I stop, what did I target, what was the logical observations that got me into it, the better you become ultimately at understanding that specific pattern play. And in time, you become very good at it and you make money out of it. That is how we would ultimately develop a suitable strategy. It came through just simply observing the market and finding something that works, capturing it more and more over time, and eventually that became our play. Now, the reason I share this story with you is because there's a very key lesson to observe in this story, which is at no point did I say to you, we would go onto YouTube and type strategy, support, and resistance. Okay? YouTube didn't really exist back in 2011. At no point did I say we would buy an expensive trading course program that was all about strategy development. Okay? We simply just sat down and utilized a very basic process called iteration, which is you sit down, you observe, and you learn what the market's teaching you. That enabled us to build suitable strategies. Okay, now what I'm not saying is I'm not saying YouTube isn't a valuable resource. Equally, I'm not saying that educational programs aren't valuable. What I'm saying is the process of developing a suitable strategy has got to come from you. Okay, Brannigan, the mentor, can give you a good idea as to what a strategy might sound like, what it might look like, where a stop should perhaps be placed based on characteristics of the trade. That a mentor can do well. But at the end of the day, suitability of the strategy comes down to you as the trader. Okay, there is just simply an over-reliance, unfortunately, from traders wanting to be told what to do. Okay, I don't know a single trader that is successful that wants to be told what to do. Okay? The major problem when you start adapting these things that are coming from YouTube, okay, the major problem ultimately is that it isn't suitable for you as a trader. Now, let's discuss a little bit what we mean by suitability. Okay? And to do this, what I first want to do is I want to illustrate with you a very big problem of suitability with this practical example. So what you can see in front of you is the image of the United States 10-year yield chart. Okay, quite a common chart. Most traders trade it. It's a daily chart for the last year. Okay, now most traders I know will in some shape or form trade support and resistance as a strategy, or level trading. Okay, now there are a number of problems with this trade strategy, particularly for traders in the first 3 years of their career. And these are the problems I'm going to go over so I can illustrate to you the concept of suitability of a trade strategy. Okay, now the premise of this trading style is that when the market approaches a predetermined level of support and resistance. So for example, when we approach this area that we're going to call S, and when we approach this sort of area that keeps being rejected, lower highs, we're going to call that R. Okay, so we call this support and resistance. Now, typically how this strategy works is when it gets somewhere near this S line, we would leave a limit order and we would wait for the market to ultimately come to us. Or some traders would wait for, like a pin bar rejection, a tail rejection, and they'll buy it the next day. So they'll use some form of a signaling confirmation. Okay, very basic strategy, by the way, and can be highly effective. What I'm not trying to do here is say support and resistance trading is bad. What I'm trying to do is show you that the suitability of support and resistance is bad for traders, particularly in their first 1, 2, 3 years of their career. Okay, now, what is the issue with this trade strategy? It's very simple. I'm going to illustrate it for you. 1, to trade support and resistance, generally speaking, you are going to need much wider stops. Why? Because as you can very clearly see by this example, there's no one specific line. Okay, I've illustrated here for you almost a 10 basis point range in the 10-year, but it's all still support. The market at no point has broken the support. It's got a number of times where it doesn't even reach the level, and it's got a number of times that it goes straight through the level and then comes all the way back. Okay, the point I'm trying to illustrate is that for most traders, this is a significantly wide stop to use. The second key problem with this is that typically with support and resistance, you do have to front run. Okay, you have to get involved ahead of the level. Why? Because if everyone thinks it's a great area of support, in other words, it's discounted, well, everyone's going to want to get their hands on it. So the speed at which the market's going to reject is supposed to be quick, which means by definition, you have to front run. Now, when you're front running, ultimately, you are assuming that there are other large time frame participants that are going to support the market. You're making a set of assumptions. Now, by making that set of assumptions, again, you have to take a slightly wider risk profile. The third key flaw or weakness within the strategy is ultimately it requires you to take greater than a 2-to-1 risk reward. Now, I can tell you categorically, I don't know many traders that take more than a 1.6, 1.7 risk to reward on average over time. I don't. I've never met someone that does more than 1.7. Okay, and I know quite a few successful professional traders. Now, it's not to say there aren't traders out there that take more than 2-to-1 and 3-to-1 risk reward. It's the mere fact that the market doesn't typically offer us risk reward of 3-to-1, 4-to-1, 5-to-1. Okay, now because you are taking a support and resistance strategy, which by definition, there's a lack of frequency. In other words, it doesn't occur very often. Okay, and given you also need wider stops, it means you do have to pay yourself for those trades. So you are ultimately going to need bigger risk reward plays. Okay, moreover, because you are taking bigger risk reward plays, you need time to allow the trade to play out. In other words, you're not going to be sitting in this trade for 5 seconds. You're going to be sitting in this trade for a number of days until it gets to target. Okay, again, also as a result of the wider stops, ultimately you can use or you cannot use as much leverage. In other words, you don't have the capability to utilize leverage in your trading. Okay. Now, these are just weaknesses with the strategy. They are not something that should prevent you from taking the strategy. But what you must recognize in the early part of your career is you need to be doing things with high frequency. You need to be doing things with very little stops. Why? Because you need to be looking after your resources. Okay, you want to be getting stuck in and involved in the market. So you need something that's going to be playing out often. Okay. That is why risk reward or level trading in the early part of your careers is not a suitable strategy. It just generally isn't a suitable strategy. And every trader that I've seen succeed typically in some shape or form, is using strategies that are more geared towards smaller stops, more geared towards, strategies that are occurring quite frequently. Okay. Now, what are the factors then that determine a suitable strategy? For one, your account balance. Okay, if you have a $100,000 account balance, fine. Support and resistance is a great strategy. Okay, because you can risk a relatively small amount of that, sit in the trade, have a wide, decent stop, and ultimately allow the market to play out. Okay, the risk per trade. How much risk are you using per trade? Right? If you only have $100 risk per trade, well, then you probably can't afford to have wide stops. If you plan to do 4, 5, 6, 10 trades a day and you've only got small amount of risk, well, the reality is you've got to do trades that allow for that. Right? The types of markets you trade will ultimately determine if it's a suitable strategy or not. Okay, some markets will tend to show support and resistance strategies. Some markets will show very frequent support and resistance. Okay, frequency expectation. Right? If you're a day trader, at the end of the day, you got bills. You got to pay your desk fees, you got to pay your hardware fees, license fees, which means you need a trade to come along at least once a day, twice a day. Again, is support and resistance coming on once or twice a day? Probably not. Okay, the style of the trader, right? If you're a fundamental trader, if you're a scalper, if you're an investor, the style that you adopt ultimately will determine whether or not the strategy is suitable. Okay, and then finally, the experience as a trader. What I found is that typically over your career, you will adopt a number of different strategies, okay? But typically speaking, in the early parts of your career, you need to be doing the simple things. You need to be doing the basic types of trade where you can keep the risk nice and tight. You've got a lot of frequency, a lot of tradable opportunities, and ultimately a lot of exposure to learning from the markets. That's the basic roadmap for suitability early in your trading career. Now, a nice way to visually look at this, and I think this is very, very important to stress, because the advice out there, and I'm going to go completely, sort of counter trend to the advice. What you'll typically read from a lot of mentors and gurus and all that kind of thing is this idea of cherry pick. You need to be specific. Only trade your play. That's rubbish. Okay, that's bullshit. It's literally the biggest problem that I find with a lot of young traders, which is they ultimately come into trading thinking that they need to just take this one strategy and nothing else, and they just sit on their hands. That's the expression you often hear: sit on your hands and wait for it. The patient trader gets paid. All that sort of rubbish. The reality with not just trading, but any skill adoption, is that the quicker you can expose yourself, the more you're going to learn at the end of the day. Okay, you do not know what trading is in the first 3, 4, 5 years of your career. So how can you expect to sit there, wait 3 days for a trade and expect to learn anything about trading? The reality is you won't. Okay, the more you expose yourself, the more experience you have, the more lessons you're going to learn, the quicker you're going to grow, the steeper your progression is going to be. That is how it works. Now, what I'm going to show you in a minute is there is a smart approach to doing this. Okay, I'm not telling you to go into your platform now, guns blazing, trade. I'm not telling you to do that. What I am telling you to do is get out of your mind this idea that you have to cherry pick and you just have to sit on your hands. That's rubbish. You need to be overactive early in your career, gain the necessary exposure and experience and understanding. And then as you're learning through iteration, what will happen is you'll start steadily pulling back. You'll do less of that because it doesn't work. You'll do more of that because it does work. Okay, it's a game of figuring yourself out. Now, you cannot figure yourself out by sitting on your hands doing nothing. Okay, the same as, guess what? Unfortunately, there's only so much you can learn in a simulated environment. Okay, and at some point, you do need to go into a live market. But like I said, there's a smart approach to doing this, and I'm going to show you this in a minute. Okay? First, this chart. What this chart ultimately all about is it's trying to give you a visual understanding of a typical trader and ultimately what you need to do in order to steepen your progression as a trader, or that learning curve. What do you need to do? Okay, now the first thing is this linear line on the bottom. This is what a typical trader looks like. They're coming on day one and they learn at a very constant speed. Okay, why? Well, because very often a typical trader comes in with this idea of, I just need to do a few things every day, not overtrade, not do too much, and I will learn. Now, yes, you can learn like that. 100% you can. But you must understand that the less you expose yourself, in other words, the less trades you take, the less risk you have on, ultimately the less progress you're going to have. Okay, because you can only learn so much by sitting and staring at a screen, by looking at charts. Okay, getting involved, getting your hands dirty is where the real learning happens. Now, what I like to compare this to is a marathon runner. Okay, imagine a marathon runner who goes out for a run every day. And he runs at the same speed every day, and he does the exact same distance every day, Monday to Friday. Okay, that's what we call the typical trader. They do the same thing every day at the same speed and the same distance. Now, compare that to a runner who runs with a smartwatch, and every single day he's running at different paces, and he's got a set program that's constantly adjusting the intensity. Which of these two runners ultimately is going to learn more about the sport of marathon running quicker? Of course, we can both agree the guy that's exposing himself to different experiences more frequently is going to learn quicker and ultimately have a steeper progression curve. It's precisely the same with trading and any other skill adoption for that matter. Okay, so that's our typical trader. Now, our smart trader or smart training is what we start to see when we have a steep exponential progression curve, and that's these two curves here. Now, what is smart training? Okay, ultimately smart training is just training with the right structures in place that ultimately are identifying key weak spots that require work. Okay, an example of smart trading is data visualization chart. So imagine all your data is on a chart. You simply look at this chart, and this chart says to you, look, Brannigan, I need you to start trading the correct risk every single day. Okay, I don't have to think. I just come in tomorrow and I start implementing the correct risk. Now, when I implement that correct risk and I make the adjustment, ultimately I'm progressing. Okay, and I'm progressing by being smart about how I go about practicing. Okay. The other types of smart trading, things like quantitative journaling or qualitative journaling, using priming questions in your journaling, okay, annotating your charts, which I'll show you a little bit later. All of these different processes and methodologies give you structure as a trader, and the structure ensures that you progress very methodically. Okay, because you're progressing day after day, you start to compound your progress, and that's what gives you that steepening effect in terms of your progress versus the typical trader. Okay, the last part is this idea of progression through iteration, and that's these little dots here. Okay, and this comes back to this whole idea, what I was just saying to you earlier, which is the more you expose yourself, the more you're going to progress. Okay, and the way to think of it is, if you simply just doing, I don't know, one trade a week, how much are you going to learn through observing that one trade a week versus the guy that's doing one trade a day? Okay, you will progress through iteration. There is no secret magic formula to progress. It's simply you've got to experience the markets. The quicker you can experience them, the quicker you're going to progress as a trader. Now, the million-dollar question, how do we build a suitable strategy? Okay, it's all about iteration. That's how you build a suitable strategy. You've got to iterate, but it's got to be done in a smart way. So, the 3 steps you're going to follow, and this is key. This is some tips I'm going to give you to building a suitable strategy for yourself. Number 1, you need to use a risk management system that makes sense. In other words, what I'm telling you to do in the early part of your career is overtrade. Expose yourself to a lot of different environments, different markets, different trade ideas, different strategies. Do all sorts of fun things in the beginning of your career. Okay, but do it with risk management in mind. In other words, on your trades that you understand. In other words, if you have a trade strategy where you've got positive expectancy and you make money, in that instance, we use what we call the ABC. Okay, we apply an A risk to the trades we know. We apply an A risk to the trades that make us money. In other words, we allocate more risk to them versus, for example, our C trades. Okay. The wonderful example I always teach to Tradelo traders is very simple. If you're learning a new trade or you're wanting to try a new market or something new, apply 5% of your daily risk to it. Do you know why? Because monetarily it means nothing. But the lessons you can learn from it means everything. Because you're iterating through a new idea. You're doing it in a cost-effective, cheap way. Okay, so I advise all traders to always be doing things in a real environment. Why? Because when you've got real skin in the game, you start to take things seriously. Okay, so the advice is do a lot of trading, do it cheaply, and you can do it with the use of the ABC system. Okay, the next step to building a suitable strategy then is you need objective data. Why? Because at the end of the day, how do you know what to do differently next time if you're not capturing the data from the first time? Okay, so every time you're buying that support level, or you're taking that breakout, or you're trading that gap open, every single time, what are the characteristics that you identified? Okay, what led the trade to fail? What leads the trade to succeed? What was the signal you used to get in? Okay, what is the expectancy like in that trade? Is it a good trade? Is it a bad trade? Right, all those sorts of things. Even how frequently does it occur? You know, so often I'd say to one of the Tradelo traders, I'll say to him, "Tell me how often your trade occurs," and they'll say, "I'm not sure." And I'll say to you, "What do you mean you're not sure? You've got to know as a trader that on average your play is coming up at least 4 times a month. Okay, you also need to know that your play on average is going to make you $1,000 4 times a month. Because that's ultimately the job of a trader, is to know their data and understand what they can do with that data. Okay, so you need to be capturing the important data so that you can iterate in a smart way. And then finally, you need to be capturing your pattern plays. Okay, if you want to develop a suitable trade strategy, you have to be capturing those ideas every single time, annotating them in a smart way, capturing the key statistics so that you can make sure that the next time it comes, you're learning and you're observing and you're growing and you're developing and eventually you're mastering. Okay, that is the process for building a suitable trade strategy. Now, wonderful quote, and this kind of summarizes this whole, first couple of minutes we've been here, which is, the faster you can fail as a trader, the faster you learn what doesn't work. And if you know what doesn't work, ultimately that's going to bring you closer to the path of true success. In other words, trading is all about a game of iterating through what doesn't work. So often traders come to me and say, "Oh, Brannigan, tell me your strategy. Can you give me a strategy? Can you share a strategy with me?" To which my response is that there are 1,001 ways to make money as a trader. Anyone can make money. It's a 50-50 in the markets. What most traders can never do is learn how not to lose money. Okay, and they don't ever how not to lose money because ultimately they haven't iterated through enough examples of what not to do. That ultimately then is how you grow and progress as a trader.